In the monetary policy statement, there is a discussion about what could be done if house price inflation became excessive. Would you prefer to use macroprudential tools first, or would you have to immediately act with a change in monetary policy, the official cash rate?
I think if we felt that this was an asset price bubble that was gathering momentum and threatening to do damage in terms of the stability of the financial system, then the sorts of tools that we would look at would be macroprudential tools in the first instance.
Do you think that regional loan-to-value ratio targets could be useful to target a housing market where one large part is moving differently to the rest?
I think once you get into regional measures, it starts getting very tricky. But I'll ask Grant, who's the head of our financial stability, and also, as you know, our Deputy Governor, to make some comments on that. I mean, there are other instruments that would form the macroprudential toolkit, if you like. I mean, one would be risk weightings on asset classes, for example. That's something that the central bank could look at if the circumstances merited it. There's counter-cyclical capital buffers, and there's also the core funding ratio requirements and that. But let me ask Grant whether he has any thoughts on regional LV ratios.
I think that would just be getting too complicated, quite frankly, and very difficult to enforce. If you allowed high LVR lending to Taranaki, low LVR only to Auckland, I think you'd find some money going to Auckland via Taranaki. So, yeah, too complicated.
Yeah.
You've said you're talking to the banks regularly about prudential issues and LVRs included, but does that mean you're concerned about the increase in high LVR lending to 95%, and I understand the last couple of weeks 100% home loans?
Yeah, I'll ask one of my colleagues in terms of the 100%. We've certainly seen LV lending in excess of 80% and also in excess of 90%, targeted often at first home buyers. But you know, it's something that in our communications is first in terms of the regular prudential reviews, but when we're meeting the senior management and also their boards, which we do regularly, we are asking them about their lending strategy in respect of LV lending. We're asking them how they see the market develop, what the potential demand is out there. So there's a regular conversation in that as we're monitoring the situation. But Grant, did you want to add anything?
I think while high LVR lending has been increasing, in other words, 80% plus LVR lending has been increasing, the amount actually over 90 is quite limited. So there'll be the odd situation where, yeah, there's a 95 or 100%, and in those situations, typically there'll be the borrower will have a lot of assets and very high good debt servicing capacity. But in terms of the bulk of the market, most of this growth in higher LVR lending is in the 80 to 90% category. And yeah, if it was getting up above 90 in any real volume, then that would be a point of concern.
But it's not at the
No.
moment.
I think if you look carefully at what central banks are doing in the OECD region, for example, basically they're inflation targeting, and that's been the case for a long time. And New Zealand was I think the first country that started inflation targeting many years ago. I think what is developed out of the global financial crisis is that just simply having low inflation does not necessarily guarantee financial stability. That you can see the potential with low inflation and high rates of liquidity and strong global growth and pickup in world trade and all of that, and changes in risk taking in an economy, you can see that you can have low inflation but still very large asset bubbles emerge that can do tremendous damage to your economy, especially when they deflate. That can cause significant impacts in terms of financial distress, unemployment, business failure, and the like. And so I think central banks around the world have been searching for additional tools to be able to try and address that and counter the risks of the potential financial instability that could emerge even with low inflation. And that's why we believe that the toolkit with the macroprudential instruments that we're discussing with Treasury and now the Minister of Finance is very important.